You walk into a bank. You ask for a loan. The bank checks a screen, nods, and says yes. A few seconds later, money appears in your account. Not transferred, not taken from someone else, not pulled from a vault. It's created. That sounds illegal, or fake, or like a conspiracy theory. But it's not. It's the core of the modern financial system, and almost nobody really understands it, which matters more today than ever. Because right now, banks are creating more money than at almost any point in history, quietly, digitally, legally. And that changes how prices rise, why debt never disappears, and why the economy feels permanently unstable. So let's slow this down. No jargon, no lectures, just the system as it actually works. Start with a simple question. When you deposit money into a bank, where does that money go? Most people imagine a vault, stacks of cash, their money waiting for them. That image is comforting. It's also wrong. Your deposit doesn't sit still. It doesn't wait. It becomes fuel. Because banks don't make most of their money by storing money. They make money by lending. Here's the first uncomfortable truth. When a bank gives you a loan, it does not hand you existing money. It creates new money. Not metaphorically, literally. Let's use a clean, simple example. You take a loan for $100,000. The bank doesn't go find $100,000 from someone else's savings. It types a number into your account. Your balance goes up by $100,000. At the same time, the bank creates a matching entry on its own books. An asset, your loan. A liability, your deposit. Both appear out of nothing. Money is born the moment the loan is approved. This is called credit creation, and it's how most money in the economy comes into existence. Not from governments, not from central banks, from private banks issuing loans. In fact, in most modern economies, over 90% of all money is created this way. Pause on that. Most money is not printed, it's typed. So why doesn't this cause instant chaos? Because there are rules. Banks can't create infinite money. They're constrained. But the constraints aren't what most people think. It's not based on deposits. It's not based on cash in the vault. It's based on confidence, regulation, and risk. Historically, people were told a simpler story. Banks take deposits, they lend a portion, they keep a reserve. That story is outdated. Today, banks lend first and worry about reserves later. If a bank needs reserves, it can borrow them from other banks or from the central bank. So the real limit isn't money, it's whether the bank believes you'll pay the loan back. That belief is everything. Which leads to a quiet irony. Money doesn't enter the economy because someone worked for it. It enters because someone promised to repay it. Every dollar created is born as debt. There is no money without an obligation attached. That means the total amount of money always grows with total debt. And that leads to the next uncomfortable math problem: interest. Let's say you borrow $100,000 at interest. The bank created the $100,000, but it did not create the extra money needed to pay interest. That interest has to come from somewhere else in the system, which means new loans, more money creation, more debt. This is why debt never shrinks naturally. The system requires expansion to function smoothly. When lending slows, stress appears. Businesses struggle. People default. Banks panic. This isn't a bug, it's the design. Now zoom out. Why does this matter right now? Because for years, cheap money made this system feel painless. Low interest rates encouraged borrowing. Borrowing created growth. Growth masked risk. But when rates rise, the illusion cracks. Loan payments jump. New borrowing slows. Old debts become heavier. Money creation decelerates. And suddenly, everyone wonders why the economy feels tight even though there's so much money. Because most of that money exists only as active debt. If lending stops, money disappears in reverse. Loans get paid down, balances shrink, money is destroyed. Yes, destroyed. Money creation and destruction happen every day, quietly, digitally, under your consent. Here's where the hype collapses. People think banks are sitting on piles of cash, controlling the world. The reality is stranger. Banks are confidence machines. They create money as long as they believe the future will be stable enough for repayment. When that belief breaks, the system freezes. That's why crises feel sudden. In 2008, banks didn't run out of money. They ran out of trust. No trust means no lending. No lending means no new money. And an economy built on constant money creation can't breathe without it. Now add one more layer: central banks. Central banks don't create most money. They influence how easily banks can. By adjusting interest rates, by providing reserves, by acting as lender of last resort. They don't drive the car, they control the road conditions, which means power is split. Private banks decide where money goes. Central banks decide how expensive money is. Governments mostly react. This is why some sectors boom while others starve. Money flows where banks see repayment, not where society needs it most. Real estate over productivity. Speculation over innovation. Not because of evil, because of incentives. So here we are, a system where money is debt. Debt requires growth. Growth depends on belief, and belief is fragile. Banks don't need your money to create money. They need your promise, and your promise shapes the entire economy. The question isn't whether this system works. It clearly does. The question is how long it works before confidence breaks again. Because every dollar you see represents a loan someone must repay in a future that hasn't happened yet. And the future is where this system lives or dies. So next time money appears on a screen, ask yourself what promise created it, and what happens if that promise fails.